Hello, everyone, and welcome back to this week's episode of the Rose and Rubini podcast, Making Sense of This World. My name is Manas Chavla, and as always, I'm really pleased to be joined by CEO and Head of Research, Brunello Rosa. Today, we're talking about a global market rout that masks a healthy repricing, plenty going on across the world's markets, but also plenty of confusion that it's generated by the direction of our economies for the rest of the year. Brunello, give us some historical context on this and tell us sort of exactly what's unfolded in the last couple of weeks. What's caused this dislocation?
So let's start what has happened. Effectively, at the beginning of last week, global markets were shaken by a sort of rout with huge sell-offs in equity markets that really resembled some of the moves seen during the pandemic crisis or even the global financial crisis of 2008, 2009. In particular, on Monday 7th, there was this big drop in the Nikkei by 12.5%, which is, a pretty large move. In fact, the largest one-day decline since the 1987 Black Monday in Wall Street. Some of us, unfortunately, are old enough to remember that in person. And then, of course, this was followed by other equity markets, particularly in the US, and in particular NASDAQ, that also fell 13% from last month's peak. As always, then there has been a bit of a flight to safety. So people sold equities to buy government bonds, in particular treasuries, and as a result, the US curve flattened, and so both the short end and the long end fell. The 2-year yield fell to 3.8%, and a 10-year yield also fell. In particular, the gap between the 2-year yield and Fed fund rate, which is in this range between 5 and 5.25%, is actually at the highest level since the global financial crisis, effectively kind of revealing that the time for a first cut by the Fed is effectively overdue.
Yeah. And so let's talk about, why all of this happened. In your newsletter, you outlined four reasons. One of them is the fear of recession in the US. Is there anything to this fear of recession?
Actually think is widely exaggerated. During the last press conference, Jay Powell described the US economy as solid. And in fact, if you look at GDP growth, remains in healthy territory, even when it was 1.4%. Clearly, it's not as brilliant as it was at some point earlier this year, but it's still a solid pace. True, the unemployment rate rose from 4.1% to 4.3%, but this is also is effectively an effect that was looked for by the Fed when they start hiking interest rates. And of course, as usual, non-farm payrolls played their roles because the number that came out, 114,000 jobs created, was below expectations. And so, as usual, on a Friday in August, illiquid markets and so on, that caused clearly lots of fears. In particular, as I was saying, the increase in the unemployment rate has triggered what people call sometimes the Saham rule. What is this about? It says that effectively that if the unemployment rates raises by more than half a percentage point above the average of the previous year, this is a signal that the recession is coming. And apparently, this signal has always worked. So it is possible that we will go towards a somehow severe deceleration in the US economy, but also let's not forget that the Fed has plenty of room to cut rates and a pickup in economic activity. So there are fears, and fears are reflected in market sentiment and therefore price action, but I don't think they are justified.
Yeah. And, A lot of the sort of the uptake in American equity markets in recent years has obviously been driven by sort of magnificent tech sector. And we saw kind of weeks upon weeks of news about things like Nvidia and its record gains just a few months ago. I mean, what's happened with the tech sector? I've heard about disappointing earnings. Has that affected what's happening now?
Yeah, so Nvidia, as we know, at some point became the company with the highest market valuations on the planet, surpassing Apple itself a few months ago. And now it's a bit of a race between the two, who's the most valuable company on Earth. But both of them have reported slightly disappointing earnings reports, although clearly disappointing compared to perhaps exaggerated expectations. So clearly there was the entire, let's call it the AI bubble, where everybody thought that, AI will revolutionize the world in the next 12 months. It's not like this. It's like when internet came and so on. It takes years for these new instruments to really feed into productivity and then transform the way things are done. So in the last few weeks, some of these tech companies have sold off and effectively returned to more, I would say, sustainable valuation. But by doing this, they have shedded almost $1 trillion in valuations. That, of course, has been reflected not just in the tech sector and Nasdaq, but in the overall S&P 500 index.
Yeah. And thirdly, let's talk about central banks. I mean, a number of central banks making record decisions just in the last couple of weeks, and our expectations for rate cuts changing radically from since the start of the year. How has this affected the market calculus?
Absolutely. People that follow us may remember that last week, in fact, we had a podcast on central bank being at a turning point. In fact, that's effectively what happened. The BOE start cutting rate already in August, as we predicted. We were not in the majority, but we proved to be right. The ECB had already cut in June and effectively kept the door wide open the way they said it to a September cut, and we expect this to happen. The Fed has not cut yet, but is clearly ready to do so. And Powell said September is the time for a rate cut to occur. And so, in fact, the question is now not whether they will cut or not, but whether they will cut by 25 or 50 basis points. So, the debate has accelerated. And on the other side, on the Pacific, the Bank of Japan has increased rates for the second time this year, first time in March, ending the negative policy rate. And the second time this now in July, they increased by 15 basis points. So they brought their policy rate to 25 basis points for the first time effectively since the global financial crisis. This has caused the unwinding of the well-known yen carry trades. I mean, throughout my entire career, I've been familiar with these yen carry trades because, in fact, the Bank of Japan is being effectively near zero rates for the best part of the last 30 years. So since I started my career, yen carry trade had been a feature of the market to the point that they have reached 40 trillion yen just counting the one on balance sheet. Then there are those off balance sheet and so on. This is a calculation by the BIS. This has been unwinding, which means that effectively you borrow at zero or even at negative rates, which means you get paid to borrow money in yen, and then you invest in whatever you want. And typically these are high yield countries, currencies, and so on. And therefore, when this reverses, the yen appreciates and the currencies that were invested in depreciate, chiefly the Mexican and the Colombian peso. So these were kind of the biggest victim of the unwinding on the yen carry trade. But again, this is more than overdue. I mean, it was totally unsustainable. And to some extent, I don't think it will stop. True, the direction of travel is changing because the Fed is cutting rates and the Bank of Japan is hiking rates. But after this turmoil, the BOJ already said, no, wait a minute, don't panic. We will remain accommodative for whatever the foreseeable future, even if we make these small adjustments. And the Fed, on the other end, they will cut rates, but would say, no, don't worry, we will remain restrictive. So some form of yen carry trade will continue also in coming years. It's just a question that some of the more frothy part of the market has been shedded. And I would say that's a good thing.
Yeah. And then finally, let's talk about everything else going on in the world, geopolitical tensions, of which there's a record amount, particularly this year, and particularly this summer. How has that affected the markets?
Yeah, this just adds and compound to all the fears that have been abounding, as we said, in the markets. We know that there has been the assassination of the leader of Hamas in Tehran by Israel. Whether this is confirmed or not, everybody knows that's the case. So now everybody is fearing the reaction by Iran. And we saw in past months that when Iran was attacked directly by Israel, they actually counterattack. In this sort of tit for tat strategy, that is, I need to react because otherwise I look weak, but I don't want to react too much. Otherwise, this goes into an escalation. I mean, it's this weird dynamic that we are seeing, but it's still, prone to, miscalculations and mistakes. Every smallest mistake can cause a wider escalation. Let's not forget, meanwhile, that the war in Ukraine is continuing. Actually, has changing his tack to some extent with the incursions of the Ukrainians in the Russian territory. So this has meant that Zelensky is not just waiting the Russians attack and defend him, but trying a new tactic, which can actually work out until the presidential elections in the US, when things more or less will be reset, and we'll start from virtually zero and to see where we go from there.
Yeah. So it seems like what seemed to many sort of market observers like perhaps the kind of harbinger of a recession or something quite catastrophic has actually been a very healthy repricing, also moderated by things that have nothing to do with the economics, much like the geopolitics or record central bank moves that are all happening coincidentally in a synchronized fashion. So, much to watch about sort of how these market movements are stabilized in the coming weeks and months. But as always, Brunel, thank you so much for your time and insight.
Thank you very much. Until next time.